The US Federal Reserve has lifted its benchmark rate by 0.75 percentage points to tame soaring inflation. Meanwhile, the Swiss National Bank has increased its policy rate by half a percentage point on sight deposits. With me to talk about what this new scenario of high inflation, tightened monetary policy and concerns of an economic slowdown means for the global corporate bond market is Christian Hantel, lead portfolio manager of Vontobel's Global Corporate Bond Fund. Good morning, Christian.
Good morning, Jade.
So we've just spoken there about high inflation, tightened monetary policy and lower growth. What does this mean for your expertise area?
Well, there's a lot of moving parts and there's a lot of risk priced by the market at the moment. It also means there's investor sentiment impacted by this. You've seen like the year-to-date total returns for the asset class is negative double-digit. We never had that. It's the worst start of the year. So there's a lot of risk priced in. And maybe more specific on the corporate bonds and the corporate issuers, it's, for example, the refinancing. It has become now more expensive for issuers to refinancing debt in the market. You can observe that when calculating the average coupon of the outstanding debt, compare it to the current yield they would like to issue. So that's something to monitor, even if it's less of an issue for investment grade companies, but still something to look at. And then the other hot topic is definitely margins. So you named higher inflation, that means also higher input costs for a lot of companies. So we see first signs of margin erosion, but it's important to put that into context. We still have a very strong margin environment. If you look back to the 90s and compare it to today, we are almost at the all-time high in terms of margins. So any margin erosion comes from a very high level.
Are these factors a risk for corporate bonds?
Yeah, the corporate bond market is relatively healthy. I mentioned the margins, so we observed that first erosion, but it's not a broad trend so far. We take comfort actually from the Q1 reporting season that has just finished. So these numbers were pretty strong and confirming a lot of the company initiative to really restore and take care of credit metrics. You could also look at corporate leverage. Companies have been focusing a lot on bringing down leverage to avoid rating downgrades. They preserved cash flows. They focus on liquidity. So overall, the situation for investment grade rated companies looks quite decent.
So valuations attractive at the moment?
I would say they start looking attractive. When we look at valuation, we typically distinguish between spreads, yields, and other components. So the spread component, and that's typically the risk premium that investors would expect for investing in the corporate bond market, has increased quite nicely. Typically, the trading range was between 100 and 150 basis points. Now we're just breaking out of that range, or we're even exceeding it already. And looking back in history, whenever we had a breakout of that range, it was a buying signal for investors. Then on yields, if you look at the corporate bond yields and compare them to the beginning of the year, you will see that they have more than tripled. So at the moment, you get like a yield of 4 to 4.5% for investment grade rated companies, which is quite attractive. And we see already first interest from mid to long-term investors that piling into the market, starting to look at these bonds and try to lock in those more attractive yields. Another interesting story is the low cash price bonds. We analyzed the benchmark indices, which exist basically since the late 90s. And currently more than 20% of the outstanding debt is having a cash price below 90. And there was only one period of time when this was worse. That was between 2008, 2009, the financial crisis. So that means for investors, you can at the moment buy an investment grade rated company bond where you would have the expectation that there's no default at the cash price around 80. So there is a capital appreciation story to be played out over time that makes it attractive. And last but not least, if you compare corporate bond yields to dividend yields, it's interesting to see that the corporate bond yields are now way higher than the dividend yields. And I believe this will attract also investors that have a more broader view on other asset classes too.
Would you say bonds are having their moment right now?
I think it looks like they're becoming pretty attractive, and the timing is always very, very tricky, also for investors and for us. But I think there's a lot of indicators that make corporate bonds look like pretty attractive, and investors with a mid to long-term horizon definitely can have their moment now to look at the market and pile into it.
So corporate bonds in particular.
Yes.
How do you go about identifying market inefficiencies?
The beauty of the global corporate bond market is that you can find bonds from the same issuer in different currencies. And when you hedge the foreign currency risk, you can still observe that one bond in, let's say, dollars might trade more attractive than one in euro. That's the additional credit spread you can lock into your portfolio because these local markets have different investor behavior. And that's worth having a look at and exploiting because it's an extra source of performance, which you can observe in any type of environment. If it's a downturn or upturn, these inefficiencies always exist. We call this spread optimization.
All right, very nice. Thank you, Christian, for coming to the studio today.
Thanks for having me.
Thank you.